In this video, we're going to move into another major category of itemized deductions, which is interest expense. So our goal in this video is to understand what types of interest are deductible, what types are not, and what limitations apply. So let's get started. All right, so as usual, let's start with the big picture. And that is, in general, personal interest is not deductible. So when you think about things like credit card interest, personal loans, or even most car loans, those are considered personal expenses and they're not deductible for tax purposes. Now that's our starting point. That is the default rule. Now, like most things in tax, there are exceptions. The main exception we're going to focus on here is something called qualified residence interest. This is interest paid on a loan that is secured by a taxpayer's primary residence or a second home. So this is where we start getting into things like mortgages and home loans, which are actually one of the most common itemized deductions for many taxpayers. Now, to understand when this interest is deductible, we need to introduce an important term, which is acquisition indebtedness. And what this refers to is basically debt that is used to buy, build, or substantially improve a home. So think about, you take out a loan to purchase a home, or you take out a loan to construct a home or make significant improvements to it. That loan would generally qualify and it would be considered acquisition indebtedness. If the loan is secured by the home, then the interest on that loan is typically deductible. Now, once we know that the loan qualifies, the next question that we're going to look at is whether there are any limitations. And the answer there is yes, there is a cap. For newer loans, the deduction is generally limited to interest on up to $750,000 of acquisition debt. So that means if if a taxpayer's mortgage exceeds $750,000, they may not be able to deduct all of the interest associated with that loan. Now, for many taxpayers, this won't come into play, but it's still an important rule to be aware of. Now let's shift to one of the areas where students tend to get confused, and that is on home equity loans. In the past, interest on home equity loans, it was broadly deductible, regardless of how you used that money. That's no longer the case. Today, the rule is much more specific. Interest on a home equity loan is only deductible if the funds are used to buy, build, or improve the home that secures the loan. So the key idea here is it's not about the type of loan, it's about how the money is used. So let's walk through kind of a quick example to make that more concrete. Let's say a taxpayer takes out a home equity loan and they use that money to renovate their kitchen. That interest is generally deductible because the funds are being used to improve their home. But if the same taxpayer uses that loan instead to, pay off credit card debt, or they decided to use it to take a vacation, which is a bad idea, then the interest here is not deductible, even though it's still a home equity loan. So again, the key takeaway here is that for home-related interest, the IRS cares about the purpose of the loan proceeds, not just the label. So it doesn't matter if it says it's a home equity loan. If the purpose of the proceeds didn't relate to the improvement, construction, building of the home, it's not going to be deductible. And that is one of the most commonly tested concepts in this section. So it's definitely worth slowing down and making sure that you're comfortable with that concept. Now let's talk about points. This is another area students struggle with, essentially because they probably haven't purchased. Some students may not have purchased their first home at this point, and it's a fairly new concept to them. Others may have, and it may click a little bit. But points are essentially prepaid interest paid when a mortgage is obtained. They're often calculated as a percentage of the loan amount. So each point equals 1% of the loan principal. So for example, if you had a $500,000 mortgage loan, 1 point would be $5,000, 2 points would be $10,000. And points can be treated in two different ways in terms of tax. Points of a primary residence. So if points are paid to purchase a primary residence, they are generally fully deductible in the year that they're paid. On the other hand, if they're for refinancing, so if the points are paid during a refinance, those must be spread out over the life of the loan. So if you're purchasing a primary residence and you're paying points at the initial purchase of that residence, you can deduct those points in the year that you pay them. But if it's a refinance, you're going to have to take those points, the total amount, and spread it out over the life of the loan. All right, before we wrap up, I want to briefly point out one more type of interest mentioned in this chapter, and that is investment interest. And this is interest paid on money borrowed to purchase investments like stocks or other income-producing assets. And the key idea here is that this type of interest can be deductible, but it comes with a limitation. The deduction is limited to the amount of the taxpayer's investment income. So, for example, if someone has $3,000 of investment interest expense, but only $2,000 of investment income, they're only going to be allowed to deduct $2,000 in the current year. That remaining $1,000, it's not lost, but it's carried forward to future years. For our purposes, the most important thing to remember is that this deduction, it's limited, and it's tied directly with income generated by the investment. So that brings us to the end of this chapter. In the next video, we'll cover charitable deductions. As always, reach out to me if you have questions. Otherwise, I'll see you in the next video. Thanks.